Hi, this is Mike Rankin with Relational Advisors, and here on a short installment of Relational Intelligence. And I wanted to share with you just some thoughts about a few short lessons on personal finance. And the genesis for this talk came up over the last 10, 15 years as I was talking to employees, participants of 401k plans, relatives, nieces, nephews, children, and I feel like some of the very basic elements of consumer debt and finance are really not taught in schools. And we live in a society where corporations are marketing to us constantly about cars or credit cards and travel and things like that. And so I think it's really important just to set the foundational basis here around a lot of these things. And so Charlie Munger, there's a quote. He's a famous business partner with Warren Buffett, and talks about the danger of debt. So once you get into debt, it's hell to get out, and it really is. It really takes a long time, and I'll show you what I mean by that. You can't get ahead by paying 18% interest, and I'm going to show you some facts as to why that is the case. So a couple of really important terms. Debt is obviously the state of owing money. Equity is ownership, and ownership can be in the form of a stock or a bond. And a stock is ownership in a corporation, whereas a bond is debt that's issued that you purchase as an investment. So you purchase that bond, they're going to pay you a set interest rate, and there's a note that then comes due, and I get your original principal back. Obviously, the creditworthiness of the bond issuer is really important when it comes to that. And then also a term of asset. So an asset is something that you own, and an asset can either be an appreciating asset, meaning one that goes up over time in value, like a home or an investment, or an asset can be a depreciating asset. And a depreciating asset is one that goes down over time, like a car. So when we think about the nature of money, we often get wrapped up in emotion, but the reality is money has no emotion. We as humans associate the emotion with that. So a couple of basics that I learned early on. There's some great books on personal finance. The Richest Man in Babylon is a very easy one to read, even as a 7th, 8th grader, 10th grader. You can get into that. And some of the concepts, pay yourself first. Save 10% of your income and spend what is left over after saving. That is a really important thing to get down early on. And don't get into bad debt. So bad debt would be credit cards and auto loans, certainly long-term auto loans, and in some cases tuition. We think that taking out a loan to go to college is a noble thing, and yes, getting a degree is really important. But we see a lot of students that end up with $30,000, $50,000, $100,000 in debt and just are swimming in debt payments by the time they graduate. So you've got to be really careful about that. And then, of course, investing in the long term. There's really no way to get rich quick, as they say. When we talk about investing for the long term, there's a concept that I want to share, and it's called the Rule of 72. And basically, without getting into the details of it, I've got an illustration of a calculator here. But basically, the Rule of 72 says at a certain rate of return, if you divide that into 72, it'll tell you how often it takes or how long it will take for your money to double. And so in this particular case, at a 7.2 rate of return, that's an investment rate of return, it takes 10 years for your money to double. So it takes 10 years in this example for $2,000 to become $4,000 or $20,000 to become $40,000. And that's with no more effort and no more work. So the earlier you can start in your investing career and have more of these opportunities to let your money double over time, this is what they call the time value of money. And the magic of that over a 10 to 15 to 20 to 30 year period truly is remarkable. So how does the Rule of 72 play into debt? Well, it plays into debt because compound interest is what we pay when we have credit card debt. And if we look at the consumer debt in America, you can see that it's growing rapidly. Clearly, student loans, credit cards, mortgages. This happens to be non-housing debt balance, but you can see it's dramatically increasing over time. So what's the problem with credit card debt? Credit card companies charge 18 to 22% interest. There may be some that are even a little higher. And often the things that we buy with credit cards decrease in value over time. And that means we basically have spent more than we can afford. There are two types of credit card users. One are called transactors, and that means that they pay their balance off every month. So what do they pay in interest? They pay zero. Now they'll pay credit card fees and so forth, but they, in essence, zero interest. Revolvers are those that keep a balance, and about half of credit card users have a revolving balance. And if we look at the revolving balance in the state of California, the average is $6,000 in a credit card balance, which is a huge number. And you can see that over time, this is from Experian, they know a little thing about debt issuance, but even from 21 to 22, the average credit card debt balance has gone up 12 to 17%, depending on the state that you're looking at. So when we play that back and we look at, okay, what impact does that have on me financially if I have money? Here's just a quick little slide showing if you have a balance of $6,480 at an interest rate of 18% and you're making a minimum monthly payment of $130, $129, it takes you 95 months or 8 years to pay that off. And you're in essence paying as much in interest as you are for your principal balance. So for that 8-year period and the $129 a month, if you actually had a zero balance and you invested that into an investment that yielded a 5% return, over that time period, that 8 years, you would end up at a 5% return with $15,000. So just imagine the two roads, that differential, right, of struggling to pay back your credit card debt in 8 years, you've finally got it paid down, versus being able to have no credit card debt and invest that money. At the end of the 8-year period, you've got $15,000 set aside. So that is the time value of money, the rule of 72 at work, and also compound interest. So the best way to avoid your credit card debt is to make a budget. There are a lot of great budgeting tools out there. Budgeting isn't fun. It isn't sexy per se, but it is the most important way to make sure that you are saving enough and not spending more than you earn, and therefore you can have a little bit of money set aside when the transmission goes out on the car, whatever you need. You don't have to put that on a credit card. So in terms of resources, I don't have any relationship with any of these firms other than they're really good resources out there. YourMoneyPage.com is a paycheck withholding calculator. So you can look at how much can I set aside in my 401k plan. You can model your paycheck to help your budgeting. Then Dave Ramsey has a lot of budgeting tools out there. Smart Dollar is his budgeting app. And then also banking calculators. I love calculator.net. They're not trying to sell anything, but if you want to look at, hey, if I invest $100 a month at a certain rate of return, what's it going to be 10 years from now? They have debt calculators, mortgage calculators. Then other firms like Credit Karma. Credit Karma is very, very good. The one thing that I would watch out for, whether it's Credit Karma or other financial services calculators and applications, is you have to watch out for the advertisers. Sometimes they have advertisers on there that are basically trying to sell you more credit card debt or debt consolidation and things like that. Do not fall for it. It feels like the easy way out, but the best way to get out of debt is to do the difficult work of budgeting and pay down those bad debts over time and be able to invest in the future. And your future self 10, 15, 20 years down the road will certainly thank you. If you have any questions, just see us at relational.com, and I look forward to seeing you.